joins us. And Laurence, good to have you back on ET Now. Thank you for joining us. Laurence, let's understand the way how world is getting divided. There is emerging market basket which is getting which is moving lower, and then there's a developed market basket which is moving higher. I'm namely talking about the US market here. Do you think this sizable disconnect between what the developed markets are doing versus the emerging markets are moving, is that real? Do you think this could extend itself for another quarter or so?
I mean, it's quite interesting. If you actually look at the longer term chart, the emerging market versus developed market ratio peaked back in 2010. And we've seen an extended period of underperformance. A large portion of that has obviously been the China derating. But quite interesting, since the 5th of November and the elections that we had last week, there's only been a handful of markets that have managed to outperform or produce positive returns. And that's been sort of Singapore, Turkey, and the UAE. The rest of developed markets, including Japan, Australia, and the basket of emerging markets have actually produced negative returns. So it's been a very small number of markets, headline indices that have actually produced positive returns since the US elections. And we've seen hesitation across the rest of the world. As far as that EM versus DM ratio, it has slowed the downside, or the underperformance in relative terms has slowed, but we've got no evidence of a major base in re-rating yet. And part of that is due to the dollar strength that you've seen since late September, basically.
Do you think the underperformance, let's say in India, is a real deal? Because India has been a strong and outperforming market, but post-October, or I would say in last one quarter, we are underperforming China massively, and we are underperforming global markets now quite seriously.
Yeah, so if you look in absolute terms, we've seen the Nifty sort of complete this topping pattern that had formed between August and October, that classic sort of head and shoulders reversal. And that still gives us a downside target around the 22,800. We have seen the mid-cap sector also roll over from this sort of rounding topping pattern that we've had for the past 6 months. And the point here is that we haven't met the minimum downside targets. We don't have evidence of slowing downside momentum. So we actually think that relative underperformance continues. And it's not until we get, evidence of support developing, slowing downside. Yeah, until we get that, we can't get more constructive. So I think we have to be cautious and just be a bit patient, waiting for those opportunities to develop.
So let's map that further, Laurence. What is it that you're seeing for the Nifty index right now? Because just yesterday on an intraday basis, we breached the 200 DMA, and it's right, well established and in the data that we're off a good 8% from the year's high.
Yeah, that's right. I mean, we're not seeing any evidence of the 200-day holding and providing a tradable entry point. The next target we have is down at the 22,800 area. But like the test of the 200-day yesterday, if we don't see any evidence from our momentum indicators, is that we think that the risks will still remain to the downside. So, as price action sits right now, I think investors have to be patient and let this corrective run its course rather than trying to sort of catch that falling knife. We haven't seen that slow to provide an opportunity at this point in time.
Do you sense when it comes to India, IT resilience is going to stay? Because the Nifty IT in the current Trump rally, while the rest of the market has been extremely thrashed out, it's IT as a sector which has managed to stay resilient.
Yeah, I mean, it's classic sort of the defensive outperformance that you see from Indian IT services, as well as the pharmaceutical space. So at least in relative terms, they've given you relative outperformance, and the tech sector with one or two stocks have held up much better than the broader market. But it's not as if we're getting fresh high momentum breakouts like we saw in India late last year and the start of this year. So it's very much more of a defensive rotation, holding relative ground rather than being, genuine long-term leadership, which actually deteriorated from 2022 for the space. So it's more of a defensive rotation rather than, new long-term leadership.
I'm just going to take a leaf from what you just indicated, that you have to be patient and let this sell-off run its course. In terms of a timeline, how much could be that pain period? Could it be a quarter? Could it be more than a quarter? Could it be the better part of 2025?
Yeah, I mean, it's a good question. I think that we can at least run into year end and potentially the first quarter of 2025. And ideally what we see develop is, finding some support in the mid 2022,000 area for the Nifty. And that provides a trading range and consolidation pattern over a quarter. And then we can start to talk about, getting new information and breaking out from the consolidation pattern. So I do think, to turn this around, having a period of ranging and consolidation that develops, and that's, we've been down for roughly a quarter. That consolidation can take another quarter. So, this is a process of 3 to 6 months to get more constructive and give us a platform for a resumption of the longer term uptrend.
You said 22,800 on the Nifty on the downside is what you anticipate, yep. Laurence. What
Yes.
about the upside? What's the range that you're calling for the index?
Well, I mean, so right now, as I said earlier on, we're not really seeing any major evidence of, a breakout or a move to the upside. But as far as the first sort of key major resistance, it's the 50-day moving average. And that had provided, key support on pullback since we had that volatility around the election results in India. The 50-day had proved support. And since late September, early October, every rebound that we've seen has run into the 50-day and been resistant. So that's currently sitting around the 24,900 area. So that's the first sort of major hurdle or resistance zone that the market would have to get above to suggest that this downtrend has ended.
How much more for the dollar before it peaks out? Look, I mean, I understand that money is moving into dollar right now, but nothing lasts permanently. At 106, 110, 115, where do you think the dollar will find its long-term peak?
Yeah, but it's quite interesting. This is an important level right now, 106 to 107. It's basically been the top end of the trading range that we've had since the late 2022 lows. And if I look at, sentiment now for the dollar index is sitting at 83% bulls. That is towards the extended level where we've typically seen the upside momentum stall out at. So this is a key resistance zone that has capped the upside over the past 18 months. So we'd look for some hesitation here at least, but obviously running through, the new administration, there are headline risks where, some of the appointments could get you a break above that 107. So that's what we're watching quite closely. And obviously the negative for emerging markets is what we've seen over time is, a stronger dollar has been a headwind for the emerging market side. So for all emerging market investors, including fund managers investing in India, a break above 107 would be a further drag on the emerging market investment case. So we're watching that quite closely. We're looking for it to stall out here with sentiment where it is, but obviously cognizant that there are some headline risk where we could see a break through that 107 area.
Also, Laurence, it's sort of well known the kind of FPI and FI outflows that one has seen from India markets. And, the usual suspects seem to be that the money is flowing into China. I want you to analyze the charts for both Shanghai as well as HSI for us, because, all the stimulus measures seem to be sort of falling flat and you're not really seeing China markets actually hold out that well. What's your reading on what the charts are indicating now?
Yeah. I mean, it's quite interesting. I think the first leg down for India that we saw late September, early October, it was rationalized that it was the rotation of money into China because you had the big stimulus and policy support through September, October. But the second leg down that we've had through October into November on that Nifty market has been more sort of earnings issues rather than the China side. Because if you look at the China price action, you peaked in early October and today, we've seen the HSI and HSCR break below their 50-day, which does leave those markets vulnerable for a deeper setback towards their 200-day. So we actually are seeing weakness, particularly on the HSI, HSCI. The domestic mainland market, so we're talking about the CSI 300 here, that still sits well above the May highs and well above the 50-day. So, the domestic sentiment has clearly changed, and those equity indices on the mainland have held up much better than what we've seen in Hong Kong right now, which, as I say, as we speak, we're breaking below the 50-day.
So, Laurence, for 2025, let's look at 3 trades. Which are your 3 big trades for 2025, which could have a shelf life of 8 to 12 months?
Yeah, I mean, so one, I'll try and put this from a timing aspect, because we have seen some short-term extremes, particularly if you look at Russell 2000, if you look at Bitcoin and you look at the S&P, that we are expecting a pullback of between 4 and 8%. But going into 2025, a pullback, particularly on the cryptocurrency space, we think there is a buying opportunity in that. So any weakness in Bitcoin back to 74,000, we think it's a buying opportunity. We've got an upside target of 130,000. So that's definitely a space that we would look at adding exposure to. If we're looking at down to the sector level, what we've seen is sort of fresh breakouts in this travel tech space, as well as the global financial services space. So those are the three spots that I would sort of focus on, wrapping up with Bitcoin, the fintech ETF that you can see that the trend and the breakout there, and then the travel tech ETF, which is also recently broken out. And these are major breakouts from basing patterns that have developed over the past 2.5 years.
Yeah, that's quite interesting, Laurence. 130,000 on Bitcoin, but yeah, why not? We're already at 90 in any case. But tell me, what about the commodity construct? Because that's where also a lot of these geopolitical events as well are sort of weighing heavy, much unlike what's happening with the equity markets. But what about crude? What do you foresee now in the charts there? And more importantly, the meltdown that you're seeing in the metals basket. You think the crash in copper is going to sustain if you do look at those charts?
Yeah, absolutely. I mean, so let's just deal with Brent and oil first of all. We've been range bound here for over 18 months. The bottom of the range has been the $70 to $71. Top of the range has basically been at 97. And right in the middle of that range sits the 200-day moving average, which we recently failed on a rebound in September. So very much range bound and in the bottom end of that range, with 70 being key support. If we jump over to the commodities, it's quite a mixed bag if you look at where commodity price action sits. The iron ore side has been quite weak, testing the bottom of the range. But if I look at the copper side, yes, we have corrected. We peaked in May at $5 if you look at the CMX copper futures. But it's essentially been range bound for the past 12 months between $4 and $5. So yes, in the near term, we can retest the $4. But the evidence that we have on the chart is that support area at $4 should hold. That the two metals that we're most constructive on from a chart side, one is aluminium. That has been basing for the past 24 months, and we're looking for a move through the 2750 area to confirm that base. So like copper, we have seen a bit of a pullback in aluminium, but the longer term profile does suggest it's basing out. And the other one is palladium, where we've seen a 75% decline off the 2021 highs. But over the past 12 months, we've seen an important base develop there, where we think palladium prices can move up between 30 to 40% into 2025. So that's what I would look at within the commodity space.
One asset class or one trade we think could be a multi-year short. For example, if someone said, I will go short in China 3 years ago, that has turned out to be the trade of the century. What is that one trade you would say that I would remain short? If it goes higher, I will short more. If it goes higher, I will short more. If it goes higher, I will continue shorting.
That's a question without notice. It's off the top of my head on a structural basis. In the near term, I think the most vulnerable market that we've highlighted has been the Euro Stoxx 600. So this market peaked in April, May. This year, you had a dip into the August lows. You've had a rally back to those April, May highs where we've stalled out and we've rolled over. So it does look like a space that at least relatively underperforms. And then we've also got this potential double top pattern.
So, Laurence, I come back to again, what are the structural markets? Eventually, what is your target on the Nifty? Because even if this bull market is not over, and this is more like a smog or a fog, in terms of the bull market pattern, what is your long-term target for this market on the Nifty or on the sensex, which really could coincide with your peak targets?
Yeah, so I mean, we've published and we've looked at the longer-term trends for the Nifty that you've had, and this is the third bull market phase of the COVID lows that tend to last over a decade, and the upside target we get from those structural moves that we've seen historically for the Nifty is that we get over 37,000 as an ultimate upside target towards the end of this decade. So we still think there's further upside, and that's why I think we do want to be looking at opportunities to increase exposure again, but we're not seeing the evidence to jump back in. So yeah, 30, just over 37,000 is where we see that longer term target for the Nifty in this phase of the bull market off the COVID lows.
That's quite interesting. And Laurence, sectorally, I mean, we've talked about IT. That seems like much a tactical near-term sort of trade. What do you think is going to drive the strength going forward? Do banks look like the strongest lot to you whenever the market chooses to recover?
Yeah, I mean, banks for us is the key sort of overweight in this, and we call it the bull market from the COVID lows. You know, it's had, of the COVID lows, it's been the state banks that led the recovery and a key driver to the upside. What we've seen in relative terms now is a comeback in the private banking space. And, you know, one of the charts that I've looked at closely and watching closely is HDFC Bank, because a breakthrough the 2790 area, we think from a large cap stock perspective would be a significant breakout. And that would sort of generate some leadership in the next leg up towards that 37,000 area. So that's one chart setup that we do like, looking forward to once we have stabilized and based out, looking for where new leadership can come from. So still banks are a key part, but a subtlety within that is, unlike the move off the 2020 lows, which was led by the state banks, we think the private banks make a comeback and drive the next leg higher.
Interesting. What about consumption, Laurence? Because what we've seen in the second quarter earnings is that there is that underlying structural, I mean, I don't know, it's not really established right now whether it's structural or just cyclical in nature, but there is a consumption slowdown. Autos are definitely seeing a bleak trend. Some of the realty names as well have fallen quite hard. And I can go on saying that about even, you know, the FMCG sector. Do you sense that some of these consumption sectors here in India would continue to consolidate, if not correct?
Yeah, I mean, I think the one that's most vulnerable, and you can look at a number of charts globally on the auto space, and the Indian autos had actually held up relatively well compared to, you know, some of the Japanese auto names that we've been looking at from the start of the year. So, you know, in that space, there does seem to be more vulnerability through this corrective phase that we're seeing currently. So again, I wouldn't be bottom fishing quite yet in that space. The staple side too, we're not really seeing any evidence, and, you know, surprisingly, when markets do sell off, you typically see that fast-moving consumer goods side give you relative outperformance. We're not seeing that from India, so there is downside risk there. And if you look at the real estate index, you know, you've had quite a significant rollover and breakdown. So again, those three spaces, from real estates, consumer staples, or the fast-moving consumer goods side to the autos, still looks like it's part of this corrective phase, and not seeing a turnaround in that space yet.
What is the path of least resistance for crude? Is it higher? Is it lower? Do you think crude is headed much lower?
It's stuck in this trading range. So we're looking at it remaining in a neutral range above $70. So we're not getting any directional trade. We haven't got any fresh information, seen a breakout from that. So for us, it's a very much a range-bound structure. If anything, because it's been holding in the bottom end of that range, there is risk to a break below $70. But, you know, that's not a high conviction setup. That's where the risk sits, because we have been sitting in the lower half of the trading range, you know, for the better part of this year.
Laurence, just to, you know, wrap it up with a couple of closing points. What do you make of this entire price action in the so-called Magnificent Seven? Nvidia, Apple, Alphabet, Microsoft, they've got crazy market cap. They looked bloated 2 years ago, 5 years ago, 10 years ago. Why is that law of large numbers not impacting some of these Magnificent Seven stocks, which now account for nearly 10 to 12% market cap of the world now?
Sure. I really sort of give you the answer from what we've seen on the chart. So there's two things that I'd highlight to you. We peaked in July. We had the sell-off into August. We've had a rebound in that Magnificent Seven index. So just focusing on those 7 stocks, that rebound has now stalled at the July high. So we have basically got double top resistance. We've got slowing upside. And then if you plot that Magnificent Seven index versus the S&P 500, that relative ratio peaked in July. the rebound that you had off the August lows has made a lower relative high. So in fact, we've underperformed since July. If you look at the Magnificent Seven as a basket versus the S&P, we haven't made new relative highs. And that absolute chart has a double top. So I think we are in a digestion phase, or the Magnificent Seven is in a digestion phase. If you look at the semiconductor side, so just to sort of take a step to the cyclical part and the semiconductor space of technology, that also peaked in July. The rebound that you've had off the August lows hasn't even got back to those July highs, and you form these lower highs relative to the July highs. So you're in this consolidation pattern in the semiconductor space as well as the Magnificent Seven. Now, within the Magnificent Seven, there's one or two stocks like Meta or Tesla most recently having broken out. But if you look at the likes of Amazon, if you look at the likes of Apple, if you look at the likes of Microsoft, you're still in this trading range. So it is more selective. The broader index is in a digestion phase, which I think can last into the first half of 2025 with the semiconductor index.
Interesting. Laurence, always great having you on the show. Thank you so much for your time.
Thank you.
If you like this video, then like, share and subscribe to ET Now.